Hello and welcome to Big Deal. I'm Nisha Poddar. Now today the focus is on the equity market deals which rise as soon as the market gains some momentum. But there are many headwinds that are facing the economy which have kept the markets volatile, and this particular factor changes the deal scenario. Let's understand from our experts joining us today on Big Deal, Deepak Ramachandra, the Managing Director and Co-Head of Equities at Axis Capital, and Rahul Arora, CEO of Nirmal Bang Institutional Equities. Gentlemen, so good to have you on CNBC-TV18. Now, Rahul, first give us your view on the market. It has been volatile, market has been tentative on the 18,000 levels, and there is inflationary concerns as well as interest rate hardening scenario. How do you view the market trajectory from here on?
Thanks for having me on the show, Nisha. So I think you summed it up pretty well. I think, we're looking into a slowdown/recession in the calendar 23. This is going to be coupled with a slightly high inflationary scenario. Even though inflation will probably directionally come down, it's still going to be higher than comfort levels for most central banks. And I think the effect of the interest rate hikes that you've seen from global central banks, India included, still need to be felt at the economic level. So I think a sum total of all of this, Nisha, if you look at calendar 2022, there have been at least 4 or 5 attempts when the Nifty has gone to this zone of 18 to 18,300, but finds it difficult to sustain there because I think people then start taking cognizance of the fact that probably valuations are running ahead of themselves. So my sense is, Nisha, 2023 is going to be a very tough year to make money in the capital markets. The journey from 7,500 at the peak of the pandemic to 18.5 was a relatively easy one. But in the face of fixed deposit rates, for example, rising as well, I think it's not going to be all that easy to defend the kind of returns that you've seen. So be moderate, be tempered, but there will be an opportunity aplenty. But, this is the first sort of global crisis that we're looking at since Lehman in this big a fashion. So we should probably have our front and rear seatbelts on as we approach the year.
All right. So very cautionary statement there, Rahul, and rightly so, because we have a spate of bad news really coming in with the recent spate of layoffs also, putting a lot of pressure on the overall sentiment for the business. But Deepak is right here with me in the studio. So Deepak, good to have you on the show. And this is your debut attempt, so we'll try to draw as much from your experience as possible.
Thank you very much for having me, Nisha.
Yes. So iBankers have been a very busy lot. Market volatility makes deals much more difficult. Timing it exactly at the window and then making returns, because the biggest theme that I have seen in the last 2 spurts that the markets have seen is the onset of investors cashing out of their vintage holdings. How do you see the overall scenario, and how difficult is it to time the volatility?
I mean, timing is always the biggest challenge, right? But I think, with everything that Rahul has said, I think a lot of investors are getting more cautious. But the equity markets and the deal markets are telling us a slightly different story as well. I mean, last year we had a bumper year, right? There were, I think, 55 IPOs raising 1,25,000 crores. This year has been slower. I think till date we've raised about $6 billion, that's 45,000 crores in 20-odd deals, 24, 25 deals. So it's been much slower this year, but almost as we speak, I think the market's picking up.
Yes.
And the deal activity has picked up. I mean, October we had just 1 deal, but so far this year 4 or 5 deals have closed. Our team, we closed the BKG deal and DCX. Those went very well. And from what I can see, we're working on 3 or 4 more, and the market has 12 odd deals, right?
Yes.
So the pipeline is strong. The appetite seems to be there for the right, the right kind of businesses at the right price. And, with all the headwinds that Rahul spoke about and we read in the papers and you talk about, India is really the preferred destination today, right? And, with the headline that we see on all the foreign selling and stuff like that, that has already abated. And there's really not many other places, funds can flow to. So we're, in a way, in a very nice spot, despite all the global headwinds that we're facing.
All right. So timing the market and catching on that window has been one of the very important tasks that iBankers have performed. But Rahul, Deepak was talking about some of these IPOs. What's your view on the quality of IPOs which have made it to the market to take advantage of this window that was presented?
So I think the one thing that's different, Nisha, and I take Deepak's point very well. I think it's the kind of IPOs that are hitting the street, because I think if you remember, Nisha, we had done a show about 15 or 18 months back where, you had a lot of these new gen companies, the Nykas, Paytm, Zomatos, Policy Bazaar, car trades of the world that were listing. And India was suddenly exposed to this terminology of gross merchandise value, or GMV, and client acquisition and retention and disruption. But you found that as soon as liquidity started receding, it went back to the conventional theory of return on equity and return on capital employed. So I think a lot of the deals that probably Deepak also spoke about that have been happening for the better part of the last 6 to 9 months have been focused in this direction. You've had a defense IPO recently. He mentioned the Bikaji IPO that his firm worked on, again, a very profitable company. You have an NBFC company whose IPO that's currently open. So I think the focus has shifted away from the easy liquidity money to quality money and sparse money, because you are in a situation, Nisha, where liquidity is being tightened. So I don't think people are going to throw it at companies where there are going to be incremental losses from here, and private equity or capital market investors funding those losses. So I think there is a definite tectonic shift in the kind of IPOs that are coming to the market vis-a-vis what it was 18 months back, and the kind of discerning money that's going in. I mean, just take a look at the subscription numbers on Bikaji and it'll tell you a story. So I think, Nisha, the interesting part is that even at a 7,500 Nifty, there will be stocks that are expensive, and even at an 18,500 Nifty, there will be stocks that are cheap or that present value. So I think if you approach the market from that perspective, where you try to marry value and growth and keep the conventional wisdom of return on equity and capital employed at the heart of your business making decision, I think life can be a lot simpler.
That's right. Market is asking all the right questions now from any of the papers which are available in the market. What's the bottom line? And I must tell you, Rahul, in that particular show, we broke it down and called it out that, these valuation matrices would not hold for too long, and that the liquidity-infused euphoria is very fleeting in nature. But one question before I move to Deepak on these IPOs. Rahul, do you think that a resurgence of the new age companies, IPOs, is going to get a shot in the market anytime soon?
They will definitely test the waters from time to time, Nisha. But I think the kind of plethora of IPOs that you saw in the better part of the pandemic, I don't think that kind of gush of IPOs is going to come back. I think it's going to be the more traditional companies that are going to come back. I mean, even if you look at a lot of these companies, right? I mean, look at what a Nykaa had to do to just prevent the lock-in from going away. They had to issue bonus shares. Zomato is now talking about, okay, fine, client acquisition was a thing of the past. We are focused on profitability. So I think the promoters themselves are being forced to think of ways to, get profitable and hold on to their investors when the time of lock-ins go out. So Nisha, I think the only other parallel that comes to my mind, and maybe my career has not been as long as a lot of investors. I've been in the market for about 20 years, but the only parallel I can draw is 2008, when a lot of real estate IPOs came out. And how many of them do you even talk about today, right? 14 years hence, you probably had just a handful of them. So I think the disruptors themselves could potentially get disrupted from an investment standpoint. And it's very possible if you're having this conversation a decade from now, a lot of these companies probably won't be discussed. But a lot of the IPOs that have come out in the last 6 to 8 months will not only stand the test of time, will probably grow into maybe in the mid caps into large cap companies. So I think that's probably the one thing that I'm thinking of that's probably visibly changing.
All right. So profitable companies, more traditional in approach, they are the ones which are still getting picked up by the investors. Deepak, what are you suggesting and advising to your clients? Are there enough new age companies which have been looking for cash and to raise funds, but do you think that they will have the appetite in the market?
I think, Rahul alluded to it as well, but I think if there are some fantastic companies out there, right? But I think the crazy valuation metrics that we saw in the liquidity-infused euphoria are no longer sort of relevant, right? So, so investors need to be more discerning in how they're valuing it and come back to more traditional metrics. But there are some fantastic companies there, and if they can demonstrate a path to profitability, I think there will always be appetite because, I mean, that's where the innovation is happening. happening. That's where the disruption is happening. And we would always advise investors to look at them for the intrinsic value of that business and how soon they can get profitable. So I think there will be appetite for the right business and again at the right sort of price.
So are you looking at a scenario some time from now where some of these new age companies with a much lower valuation expectation could make it to the market? Is there any timeline in mind? Is the work going on that front at all?
There's a lot of work going on, and I think in the year ahead, we are seeing, $4 or $5 billion of sort of IPO pipeline in the new tech sort of tech space, and some of them are very, very good companies, like I said. Valuation and depending on how the markets are at that time will always, will determine whether they come to market or not. But I think yes, there will be a window. Again, like you said, timing is always key. But I think given how people have burnt their fingers in the past, the way they will approach the valuation of these companies will change. And I think that has probably changed for good.
All right. So a new normal in the valuations of these companies in a new market environment is something to be watched out for. That's an important takeaway. In fact, on that note, I'll quickly take a short breather while you digest all the points that have been made by our panelists, and we'll take the conversation forward on the other side. Stay tuned to Big Deal. Welcome back. You're watching Big Deal and we are discussing the equity market transactions in a volatile market. Now, Deepak, we spoke about the IPOs and the IPO pipeline. Now, last year, at the same time, some of the companies managed to go ahead with their IPOs with euphoric valuations and bumper listings. Now, they are all coming to the next milestone, which is an important part of their IPO journey, is the IPO lock-in period getting over for the pre-IPO investors. We saw a huge amount of pressure and impact on Zomato earlier. Now, Nykaa has happened this week. Paytm and Policy Bazaar, and Paytm in particular, will be a cause of worry going forward. How do you see this IPO lock-in period ending? Also, with now liquidity going away from the foreign market as well, how are the investors from the foreign markets poised in this particular period?
So I think yes, it's much talked about the lock-in coming off. There's a huge amount of paper to hit the market. Some have, like you said, in Zomato's case, obviously impacted the price. But I think we've had a phase where valuations have corrected, in line with how these sectors have performed globally. But if you think about it in the slightly shorter term, Nykaa actually today even, right, has held up very well, right? It's been very resilient.
They have been quite strategic, to say polite.
Yeah. But I think what we're seeing is there is sufficient demand. Now, I'm not saying there might be demand at this level, but these stocks will all find a level because they're all relatively good stocks in a space where, where they're sort of differentiated, right? So I think we will find a level. It's anyone's guess what that level could be, but just given the price action in recent weeks, we think that, this price, the levels could not be too far away from here. And so that's an encouraging sign. Now, how are foreign investors thinking about this? Are you specifically asking about the lock-in period or the environment in general?
Environment, especially connected to the lock-in periods ending. So will they take the opportunity as soon as the lock-in period ends?
I think what we've found in the work and the inquiries that are coming from our foreign investors have been around this space. Now, they've all obviously had exposure to these kind of businesses in the markets that they are sort of domiciled in, the US investors and Asian investors. So they've done a lot of work. And for them, these are, either they've already come in the IPO stage and this is a way for them to sort of average down. But a lot of new investors have done a lot of work on these names with us. So we believe that appetite will actually be driven by some of these foreign investors as well. So that foreign money is there, and that's where the bid will come from.
All right.
But not to put away some of the domestics who are actually waiting for it to come to the right level. They're far more discerning and cautious on these names. But I think at a level, we've seen them come in as well.
All right. There I have to give it to the domestic institutional investors who actually had much more prudent approach to the investments than the foreign investors. All right. So, Rahul, you mentioned about Nykaa And I was asking Deepak about the other two, which are also lined up. From the sense that I got from what Deepak said is also that most of the negative news probably is baked in, and the stock prices are substantially lower than their IPO price. What is your view on these companies, now Nykaa as well as Paytm, Policy Bazaar?
So, Nisha, if I can just on a lighter note, the famous Maruti commercial, which actually spoke about the economy of the car, and the tagline used to be "Kitna deti hai." I think the question is you have to ask what kind of returns at what acquisition price. And as you very rightly pointed out, I think most of these new age technology companies, whether they were in fintech or consumer tech, are down to anywhere between half to about a fifth of their 52-week highs. Let's take a look at Zomato, since you were discussing that with Deepak a little earlier. I think Zomato's high was about $190 or thereabouts, currently trading at about 60, give or take. Now, you're sitting in a quarter where you have a 2020 World Cup and then you have a FIFA World Cup to follow. So obviously the delivery business is going to do really well. Now, these are just case in points. So now the question is, do you invest in these companies as a trade, or do you view them as long-term investments? But I think if the trajectory of profitability is all right, which basically means is if a company has done 100 crores of losses in year A, if that number can come down by 15-20% and I have visibility of that, I'm okay if the losses are there, but they're coming down. But because the prices are at 1/4 or 1/5 of 52-week highs, it becomes a slightly more compelling investment argument. So this can probably be applied to across the board. Nykaa is obviously probably more an urban or a tier 1 or a metro kind of a story. So if you're positive on, urban discretionary, I think Nykaa at the peak was about 2,500. So these are cases you can make. I think a lot of these are at interesting price points. Nykaa is an exception because I think it does make a profit and it has a marginal return on equity as well. But I think if you try to marry the fact that losses will come down, it's not going to require further private equity money to fund the losses, and the fact that they've come off substantially, they may not be bad trades or investment ideas.
All right, so quite compelling at these price points, and also, but I would think about the pre-IPO investors who invested at much higher valuations and may be under pressure to really cash out, because for the time being cash could be king and they may want to cash out. So that's one of the aspects to really watch out for.
Can I make a point there? You talk about the pre-IPO investors and the private equity investors who might want to cash out. Now, they've identified these companies very early on. They're sitting on, despite them, many of these have come off quite a long way. They're still sitting on very good returns. But our conversations with our private equity, clients, they've displayed a pretty good sense of responsibility around it. They want this to happen in an orderly fashion.
Right.
While they obviously want to time the market and get the best price out, I think they want to see it in an orderly manner, right? And continue to be sort of responsible partners to whichever companies they've invested in.
Yes.
Because they all own fairly significant stakes in these companies. So unless it's a full exit, they would want this to happen in the smoothest possible manner with the least impact.
That's a very important point, and that's what I was watching out for in Zomato as well, and that's where an investment banking advisory also comes into play to a large extent. And also the founders' relationship with the investor community is also very critical at this point. But let me jump to another important asset class that we have built over the years, and in an interest rate hardening scenario where capital is going to get expensive and equity market volatility may not give you that premium pricing. At that time, REITs and InvITs are coming handy for many capital intensive sectors. What is the action there?
Yeah, those two spaces are just absolutely going to roof it, I think. Like you were talking in the break, the space is ready to explode. We've had some good transactions over the last year or so. The people are understanding these products much better. The REITs, obviously, with anybody who wants a yield, but the growth pickup of equity,
yes,
that's a great sort of way to do it. On the InvIT side, it's really what has happened is, it's allowed us to segregate developer exposure and operator exposure, right? And that has been key because a lot of people in the past have lost their shirts, if you may, on taking developer exposure. So the InvITs allow you a fantastic vehicle.
Are you seeing a huge amount of interest? Because we have
yes,
unlisted also ones now, not publicly traded. There again, a lot of money can really come in.
Absolutely. And the InvITs is where we're seeing a lot of action. Our teams teams are working on 3 or 4 very large transactions at the moment, and we're seeing interest from across the board. And that's the other point. The depth of this market also has expanded, over the course of the last 2 years. So it's not just the big foreign sort of income funds. There are some domestic balanced funds that are coming in and are looking for it. There are family offices that want to...
And with the thrust on infrastructure development by the country. Rahul, very quickly, your end note on this particular space. How bullish are you on this? Because in an interest rate hardening scenario, in a volatile market, a safe investment with a fixed and equity combination, which REITs and InvITs present, could be a safer and a more cautious approach for many investors.
So I think, Nisha, the best way to look at it is it's an alternate investment class. So when you talk about alternate investment funds and a reasonable amount of exposure that goes into it, it's the markets in India are not that deep and penetrated or liquid on the non-equity side, which is debt, and the Reserve Bank of India and the government have been doing whatever they can. The good part, Nisha, is that especially on the InvIT side, the government of India itself is doing a lot of deals. Whether it's gas pipelines, power transmissions, and a lot of others. I think a lot of road projects are coming through InvITs. And when you have the government of India, going down this route, it becomes that much more reassuring for the private sector to go down. As far as REITs are concerned, I think you and Deepak have summed it up very well, because you look at yield and, even as an equity investor, sometimes you look at dividend yield and free cash flow yields of companies. And a lot of these, sometimes if they can give you, like 8.5%, which I know are not fixed deposit rates right now, they become very, very good investments. So just take a look at the 2 largest REITs that are listed on the stock exchanges. Embassy, which owns assets like, Express Towers in South Bombay and a couple of very marquee properties in BKC, and Mindspace, which owns pretty much most of them in the Mulund area. So if you have in leaders in the space where they have the bulk of the assets, I think you can look at it as a possible alternate investment class, because I know for a fact that a lot of AIF fund managers actually are looking at deploying a lot of incremental money down this route. So as Deepak rightly said, I think this is a space that's going to expand. It's going to get deeper. It's going to get more liquid. And it's a fantastic proxy to play the equity markets on an uncertain time.
Also, if I may add, not looking at it from the investor class, but from the point of view of the companies which have fewer options of getting cheaper funds or funds at this particular period, with capital getting expensive on the debt side and equity market maybe not giving that value, this could be a great way of really offloading the capital intensive projects which are already, commissioned, and then pump in the rest of the money and the bandwidth that the balance sheet has in building new projects as well. So that's one of the critical areas where REITs and InvITs can really play a very important point. Thank you so much for all the insights, and this discussion is going to continue on equity market deals. Thank you so much, Deepak, as well as Rahul, for joining us with your insights. With that, it's a wrap on Big Deal. Thanks so much.